All right, let's dive in. Today, we're going to move past the headlines to really dissect the architectural blueprint of private equity. We're talking about the legal structures, the key players, and the flow of capital that truly define this industry. Let's get started.
First things first, you really need to get your head around the sheer scale of this industry. As of today, we're talking about global assets under management that have blown past $13 trillion. This isn't just some niche corner of finance. It's a massive force that's actively shaping corporate strategy and the entire global economy.
So what does this industry actually do? Well, at its very core, private equity is an agent of transformation. It steps in with capital and deep operational expertise when companies are at these critical turning points. Maybe a founder is looking for an exit, or a division is carved out of a big corporation and needs a whole new strategy, or maybe it's just a mature business that needs a serious operational overhaul. This is about so much more than just money. It's about active, hands-on value creation.
Okay, so how does all this capital get put to work? Well, the entire structure really hinges on the relationship between two key players, and each one has a very distinct role.
First up, you've got the limited partners. We call them LPs. Think of them as the capital providers. We're talking about huge institutions like pension funds, sovereign wealth funds, university endowments. They allocate a slice of their portfolio to private equity because they're hunting for higher returns, to meet their own long-term goals. And then, on the other side of the table, you have the general partner, or GP. This is the private equity firm itself. They are the architects, the operators. The GP is responsible for everything, the entire investment lifecycle, finding the deals, doing the due diligence, managing the companies they buy, and of course, figuring out the best way to sell them later on.
And this table here, it really lays out their relationship perfectly. The GP is the hands-on, active manager with a legal duty, a fiduciary duty to the LPs. The LP, on the other hand, is a passive investor. Their financial risk is legally capped at whatever amount of capital they promise to invest. This distinction, it's the absolute bedrock of the entire private equity model.
So this brings up a really critical question, especially for any of you who might one day be an LP. Think about it. You're locking up your capital for a decade, maybe longer, and you have zero say in the day-to-day decisions. So how in the world do you pick the right GP to be your partner? What qualities matter the most? Okay, so we know who the players are, but how is this whole partnership actually structured from a legal standpoint? It's all formalized through a very specific vehicle that governs the entire relationship, the limited partnership.
The go-to structure here is what's called a closed-end limited partnership. It's essentially a blind pool, which means LPs commit their capital based on the GP's track record and their strategy, not on some list of pre-identified deals. So, for example, when a firm like KKR goes out to raise its next giant fund, investors are betting on the firm's ability to find the next big thing, like an Avago Technologies, not on a preset shopping list.
And that brings us to one of the most defining features of private equity, the timeline. Look, we're not talking about quarterly returns here. We're talking about a decade-long journey. So this timeline follows what's known as the 10+2 model. A fund has a fixed 10-year lifespan, usually with an option for 2 one-year extensions. The first 5 years or so are the investment period. That's for buying companies. That's followed by a holding period for active management and creating value, and then finally a divestment period to sell those investments and return the profits.
Now, this is super important. LPs don't just wire all their money on day one. It doesn't work like that. Instead, the GP makes what are called capital calls to draw down the money as they need it for a specific investment, sometimes with only 10 business days' notice. This just-in-time funding model has huge implications for everyone involved.
And all that committed capital just sitting there on the sidelines waiting to be invested? Well, it has a name. We call it dry powder. It's basically the industry's firepower ready to be deployed into new deals.
And the amount of this undeployed capital is just staggering. Look at this. Industry dry powder has ballooned from a couple $100 billion back in 2000 to over $3.9 trillion today. Now, this creates enormous pressure on GPs to actually put that money to work, which leads to intense competition for deals and can sometimes inflate prices. So the question for you as a future leader is, where do you possibly find value in a market that crowded?
Okay, let's talk about a pro tip here, something you might not find in a standard textbook, but it's absolutely crucial for understanding the trust in this industry.
So when LPs are doing their homework on a GP, one of the first things they look for is what we call skin in the game. They want to see the partners investing their own personal money right alongside the LPs. A while back, this was maybe 1%, but today it's often 2 to 5%, or sometimes even higher for the top-tier funds. We're talking about a huge personal investment from the partners themselves.
And look, this is not just symbolic. This is the fundamental alignment mechanism. When the GP's personal wealth is on the line, right next to the LP's capital, it ensures that every decision is made with one shared goal: maximizing the fund's returns. That's the bedrock of trust in this whole blind pool model.
All right, so let's pull all this together and recap the core architectural principles we've just covered.
It really boils down to these 4 pillars, right? First, you've got that symbiotic relationship between the LPs bringing the cash and the GPs bringing the know-how. Second, the whole thing is built on that long-term, closed-end limited partnership structure. Third, you've got that very distinct 10-year life cycle of investing, building, and then selling. And finally, there's that unique capital flow of commitments and capital calls, which is what creates all that industry dry powder.
Look, understanding these mechanics is one thing, and it's essential. But at the end of the day, private equity is this incredibly powerful engine for corporate transformation. So the real question I want to leave you with is this. As a future leader, how will you direct that engine to create not just financial returns, but real, lasting value?